Hey everyone, on August 13th, 2024, Serve Robotics gave a critical investor update. Of course, Serve Robotics became popular with investors because of Nvidia's investment in the robotics technology company. In this video, I'm going to share with you the latest details from Serve Robotics, including information about its expansion by 2,000 new robots and how the company is raising money so that it can continue spending on research and development to continue its ambitious growth plans. So let's take a look at this interesting robotics company.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So in this investor update, the company's management team saying that looking ahead, we are focused on executing Serve's fleet expansion plan to deploy at least 250 additional robots in Los Angeles by the end of the first quarter in 2025. We believe our continued execution of this plan through year-end 2025 will position Serve to deploy all 2,000 robots under our Uber Eats agreement, which at full utilization is expected to generate 60 to 80 million in annual revenue run rate. Now that 60 to 80 million is a long way away from where the company is now, where it's generating less than 1 million in revenue on a quarterly basis. Now, because the company is not up to scale just yet and it's spending so much on research and development, it's still losing a lot of money on the bottom line, and so it needs to keep going to investors to raise capital so that it can fund its operations until it reaches a sustainable level. And on April 18th, Serve completed a successful public equity offering, which generated $40 million in gross proceeds. They also completed a private placement transactions with gross proceeds of $15 million. In total, they netted $55 million for the company. Now, remember, when a company is raising money through equity offerings like these were, it dilutes existing shareholders. That means there are more shares outstanding. And why that's important for investors is because with more shares outstanding, if or when the company does reach profitability, they need to split those profits among more shares, which decreases the earnings per share. And so that's important, and investors would prefer the company reach a level where it doesn't need to dilute shareholders sooner rather than later. That's why these quarterly milestones are important. You want the company to make progress at a reasonable rate so it doesn't have to keep going back to investors and raising more capital and diluting shareholders even more. The company also achieved an 85% increase in daily active robots year over year and a 23% increase quarter over quarter. In June, Serve announced the expansion of its delivery operations into Koreatown and began onboarding new local merchants through its partnership with Uber Eats. Now, if you don't already know, Serve Robotics is only operating in the Los Angeles area. Koreatown is a part of Los Angeles, and so they're expanding into an additional area within Los Angeles. So they're still within the Los Angeles area, really trying to prove its concept before they roll it out into new cities and new geographies, which they are planning to do. They're not planning to stay in Los Angeles as its only market. They are planning to roll it out, but for now, they're just in Los Angeles. So in the second quarter, Serve commenced their manufacturing activities on their 2,000 robot fleet. They also entered into a purchase and production agreement with Magna, under which Magna will become the contract manufacturer for Serve's delivery robots. And that's important for investors to know. Serve is outsourcing the manufacturing of its robots. And these are delivery robots. If you live in the Los Angeles area, you will have seen them around. I've certainly seen them around. I live in the Los Angeles area. And these little robots, they deliver food for restaurants to consumers' homes. And these are expensive to make. And you want to conserve capital as much as possible when you're a young startup company. And so this outsourcing strategy is an asset light strategy, which I tend to prefer. and it also is lower risk for a company that's already very high risk in Serve Robotics because of all the research and development spending they have to do without knowing exactly or precisely how the research and development is going to pan out. And so anywhere you can cut down risk a little bit when you're already a high risk company, that's favorable, and I agree with that decision to outsource. So second quarter revenue came in at 470,000, but that included 300,000 from software services revenue from the deal with Magna, but that's going to end. Serve's services contract with Magna was completed during the second quarter, and the company does not anticipate any or material software services revenue in the third quarter of 2024. So a big part of its quarterly revenue is going to go away, and that's going to bring down Serve's revenue from that segment. Now, if you're curious about just how many robots they have in operation right now, they have 48 daily active robots in operation as of June 30th, 2024, and that was up from 39 in the previous quarter ending March 31st. So they added 9 robots in the quarter. Year over year, they added 25 robots. Last year in this same time, they had 23. They now have 48 robots. The daily supply hours also increased from 300 to 385 in the previous quarter. And year over year, it more than doubled from 152 to 385. These robots are quite common if you're, like I said, if you're in the Los Angeles area, you see them often. And I've seen them more and more lately. They, just to give you an idea of how they work, they are relatively slow and clumsy. And when they encounter people walking or cars or people walking their dogs or something, they just pause and they stop and they panic and they just kind of wait. And I can imagine, I've never had a delivery with one of these. I haven't experienced a delivery with one of these robots, but I can imagine it takes quite a long time to actually get your order from the time it was delivered, from the time it was ordered, unless you live very close to the restaurant you're ordering from. Again, I'm hoping this technology improves because the food delivery segment, people are ordering and people are saying to, Uber Eats and DoorDash that they like this service. They like ordering food for delivery. So this could certainly help in that segment in saving costs because it's very expensive to have a driver pick up your food and bring it to your home. If that can be replaced with these delivery robots, that's a big improvement. And so companies like Uber Eats are understandably very interested in this technology. So as I highlighted, you can see the software services revenue was the biggest part of Serve Robotics revenue up until this point. But given that their deal with Magna International has ended, it'll be interesting to see if they can replace that with a different kind of services revenue, because just the delivery services and the branding fees alone barely make up a little more than half of what they were getting in software services revenue. So this is something I'll be looking out for if I can get more information from Serve Robotics about their next software services revenue agreement. Now, following the earnings release, the stock price jumped up from a little over $10 per share up to $12.99. And the stock is now trading at a forward price to sales of 30, which is very expensive. And given its innovative technology, investors are optimistic about the company's prospects longer term. For me, I still think it's too early for an investment in Serve Robotics. If I was to say if the stock is a buy, hold, or a sell, I would say the stock is a hold right now while we get more information on its progress in its expansion plans. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.